a recent blog post, I broke down the situation surrounding the unraveling of the Accell group. Because of the strong feedback I got, I reached out to Sam Nicols to do a deep dive on the topic. Sam is the former CEO of YT Industries and currently serves on the board of directors at Propain. Together, we traced the path of the $1.4 billion deal to take the company private at the peak of the COVID boom by PE juggernaut KKR. We discussed the painful Babboe recall and collapsing mid-market demand, which eventually led KKR to walk away from roughly $1.1 billion in equity earlier this year. Sam brings operator insight from his time leading YT through a similar downturn, and we dig into what it would actually take for Accell to find stable ground again, if that's even possible. This is the Business of Cycling podcast. Sam Nicols, thank you so much for coming on. We had spoken about getting on and talking about the situation with Accell, which feels like it was a little underreported in a sense that like it's a really big development in the business. There were a few reports on it, but I thought we kind of agreed that maybe we should dive a little bit deeper into it since this still is, a developing story. But I thought you would be a great person, with your managerial background and acquisition background. And so this whole story kind of involves all of those pieces. And so we'll dive into that and give kind of the audience a little more insight into what's happening, which from, a quick article that I wrote had really good feedback. So we're going to go a little deeper today on that. So anyway, thanks for coming on, Sam. Love hanging out and talking. Since we last talked, do you have any updates you want to tell us about? I know you've got a new role.
No, not, well, first of all, thanks for the invite. Certainly, Excel has a lot of things we can talk about. So I'm happy to be here and chat away with you a little bit. I mean, from my side, no, I'm still doing my board gig with Propain Bikes,
Was that
and
public last time we spoke?
I think so. Yeah,
Was it?
I think that
Okay.
was public. But
Okay.
so that's kind of my evening job. I have a day job running Europe's largest retailer of cameras, but I remain very interested and involved in understanding what's going on in the bike industry. So yeah, happy to take the time to talk through with you.
Okay. Well, yeah, no, that's awesome. And I think why don't we just dive right in, give the people what they want. What do we need to know about Accell?
So Accell, the way I would describe Accell, it's a European conglomerate of brands. The brand was built, well, it was put together over the last 20 years as bringing in individual brands and put together into a group. So Accell is not a customer-facing brand; it's the holding company on
Holding
top,
company.
and it's made up of a number of brands like Haibike, Raleigh, Lapierre. It predominantly sells in Europe, and it's strong, I would say, in the mid-market or low to mid. So, and also exclusively via distribution, so just bike shops, not a direct to consumer. None of these are direct to consumer brands. It's all go into your local bike store and you will likely see Accell bikes around. And I guess for the sake of this, was put together as it stands now already before Corona. So it was a strong existing company. And it was actually, interestingly enough, pre-Corona, it was also publicly traded. So it was one of the very few bicycle companies that was publicly traded together with Shimano.
On the
And
Netherlands stock
yeah,
market. Yeah.
so it was, you actually have a lot of insight into their financial performance, which was, slow and steady growth over 20 years and not crazy profitable, but reasonably profitable.
Yeah, but that's
And
cycling, man. Like I continue to come back to this. It's like if you want to grow fast, go get into software. If you want
yeah,
to, if you want to have healthy, long-term, mature business, that's cycling. Cycling is generally a pretty mature business, and explosive growth is pretty hard to find. I mean, what do you say to that, being kind of in the business?
yeah, certainly it was before Corona. And then with Corona, there was this, big abnormality of,
But it was abnormal. It was not
yes.
right.
And yeah, I would say pre-Corona, bicycle industry was low growth, low margin. I think you could say that it was good, but it wasn't great. And there were probably some exceptions in there, but let's say look across the bicycle industry in general, it was solid. And Accell certainly was a solid performer in that period, not stellar, but doing just fine, chugging along. And then Corona came, and maybe that's probably the first place to say is that when Corona came, Accell was in a very, very, very good position to take advantage of the boom which occurred 2020, 21, and maybe into the beginning of 2022. So Accell's product portfolio is anchored around, like I said before, kind of I would call it low to medium priced bikes, starting at a couple €100 going up to cheaper e-bikes. Those were the bikes that you wanted to have in Corona. That's where the demand came. As people were buying bicycles, they wanted to buy a reasonably priced bike. And basically, they had the perfect portfolio for the start of Corona, for the boom when it hit. Low priced e-bikes, commuter bikes did really well. In that, I would also add that they most likely benefit being a producer that sells through dealers. They typically carry much larger inventories, those kinds of producers, than a direct-to-consumer bicycle company. And I think it's reasonable to assume that Accell entered the boom with large inventories compared to some of
Sure.
their competitors.
And so
And
on
this
paper,
actually, yeah,
on
on
pa-
paper, perfect, right?
and so probably they were showing a lot of growth, a lot of margin, as well as a lot of upside during COVID, and then I guess so that would have sort of twisted or exaggerated the actual performance because of those conditions. And I guess we can kind of assume that that's what brought the investors to the table uh, with the macroeconomic situation of Corona, and then Excel was an incredibly attractive, we'll say, organization during this time because of the growth and because of the margins that they were showing.
Yeah, I think that's the right way to put it, that they could sell through older inventory relatively quickly and at full price. And if Corona hadn't happened, they would have had to sell through that by discounting, which is a
Right.
normal product cycle, that
Or
things that
slower.
don't sell
Yeah.
during the year, you discount at the end of the year. And then usually it's okay because the things you sold at full price offset the things that you discount. And then that's how they ran their business before. But now all of a sudden, all of their old stock that was lying around, which they had assumed they would have to discount now, is actually able to be sold at full price or even potentially at a price premium. There was a lot of price increases. I'm not sure if KKR or if Excel did that, but certainly when you look at their numbers, the publicly available numbers, there was a lot of growth in revenue and growth in profitability in 2020, 21, 22
Sure.
at a time period when not all brands grew because there were supply chain challenges. So they had bikes readily available to sell, and those were the bikes that you wanted to have when the boom came. And and you mentioned, I mean, KKR investors. So investors got really hyped about the bicycle industry.
Yep.
One of the things you have to remember is there's people who, if investors want to get in to the bike industry, they also have to find somebody who's willing to sell. And I mean, I can't have insight into every single major bike company, but my understanding is that the traditional, let's say the large bike companies, Specialized, Trek, On, I haven't heard any rumors or speculation that they were looking to sell during that period. And so if you were an investor looking to get in the door, Accell being publicly traded, it's on the stock market, you can it's accessible. You can make an offer to the shareholders to pay a premium for the shares, and you can take it off the stock market, which is eventually what happened. And I think there was a lot more interest than there were potential targets. So there weren't that many bike companies looking to
Right.
sell.
Right.
Excel was one of those, and they had great numbers during, let's say, when the deal got announced early 22. Their 2021 numbers were a record year for them.
And if we go back and look at the time Canyon had sold, YT had sold, which you were part of that.
Yep,
You were the CEO of YT when they were sold in 2021.
correct.
And so it looks like it was kind of this perfect storm of we can call it artificially high margins, artificially high growth, lots of money in the investment money out there because of low interest rates at the time. And so
Right.
sort of this fully blown kind of exuberant moment of investment into cycling. And who comes to the table but KKR? And KKR, for people that don't know, is like the inventor of private equity, I think. I think they were like one of the first firms to do debt leveraged private equity. So they are like a hugely infamous name in private equity.
Correct.
And they actually were the ones that purchased the company in 2021.
Yeah, I mean, it was early 22. It was
22.
announced, the deal. And I think it's really important in hindsight when you look at it. KKR announced the deal, it was January 2022. And that I would say was the absolute peak
Yeah,
of 2021 numbers. Everyone looked great. The industry was growing, or everyone was super enthusiastic. There have been a number of big deals that had already happened. You mentioned a couple of them. By the time the deal closed, closing, they announced the deal. That's basically when they say we're going to do this. That was January, and then typically with these deals, it takes a couple of months for everything to go through legal approvals and things get finalized. And let's say the deal got finalized in summer of 2022. And I still remember the summer of 22 when I read about, KKR now has taken Accell off the stock market and has paid a massive premium to the customers on the stock price, which was already inflated due to Corona in general. And I remember thinking, I was really surprised, actually, personally, because at 2022, mid 22, we were already seeing softness in demand
oh,
in
okay.
the industry.
Right.
And I was surprised seeing that KKR has a reputation of being extremely astute, business people who look at all these things. It seemed to me that the deal happened way too late, that there were already strong indications that this was already starting to go downhill. Or let's say this being the industry,
Sure.
not Accell particularly, but say that the peak was passing, that demand was softening, that all of a sudden those bikes you ordered were maybe a liability and not a benefit anymore. And I was surprised that the deal went through in the end. And I think what unfortunately for KKR, they bought the company based on 2021 actuals, which
Sure.
was a fantastic boom peak. And then they inherited the company in 2023, which was a complete opposite, or let's say the external situation moved from being the biggest boom ever in the bike industry to the biggest bust ever in the bike industry.
Right. And in hindsight,
Yeah,
again, it's, easy to look back and say, well, what were they thinking? But, we can go back to what we spoke about earlier. There were all these factors that just sort of brought them to the point that they're at, that they arrived to actually do this deal. And I think it's easy, or it's fair to say that anybody that did a deal from 21 to 22, um, did an unbelievably poor quality deal and are in, you know,
yeah, I
are,
don't know, poor quality deal. I mean, in hindsight, I would say they lost a lot of money on the deal,
yeah,
or they certainly didn't. If they were lucky, they get their money back.
right.
And I think a lot of people will lose a lot of money.
Yeah, yeah. I don't,
I mean, it was it a I mean, it's really easy in hindsight to go back and
sure.
say,
No,
yes,
it
they
is,
they
but I'm just,
overinvested, and there were certainly many investors who made similar bets.
yeah,
And when you looked around, and I think there was a bit of fear of missing out going on in the
yeah,
industry with
absolutely.
people wanting to get in and feeling I need at least one bike brand in my portfolio, and then I'm okay. Uh, and uh, and yeah, I mean, KKR was the last big one that went through of the bike deals. And then basically middle of 22, the whole investment cycle stopped. Nobody was buying any new companies
Right.
unless it was going bankrupt. That was the next phase of companies going through bankruptcies and certainly on the side needing cash injections, which everyone probably needed, or almost every single bike company. But I think Accell or KKR stepping in, taking over Accell, and everything that had made Accell such a fantastic opportunity in 2021 like particularly their selection of bicycles or their portfolio, which was exactly what consumers were buying, all of a sudden became the biggest liability because
Where the
those were the
overstock was.
segments,
Yep.
yeah,
That were
that were hit most acutely by the overstocks, because that's where everybody had doubled up on ordering, and all the people who had bought cheap bikes didn't need to buy a second cheap bike. Whereas premium road and premium mountain bike was okay,
weathered it. Yep. A
particularly
little
premium
more.
road, but yeah, the entry to mid-level just really, really suffered. And so everything that was upside in the past all of a sudden became a massive, yeah, a challenge for any brand that was in that area was going to be facing immense difficulties
Well,
to
and
make that transition. And Excel had I mean, now they were layering on a couple other difficulties because they are now private equity owned. And not that private equity per se is bad. It's just how private equity invests in a company. They typically leverage, so they borrow money from banks to pay the purchase price and then have to service that debt along the way. And that means that not only are you facing a downturn in demand and overstocks, you also have a ton of debt that you didn't have before the deal, which really limits your options in
and
terms of your ability to weather that kind of downturn.
yeah, and I want to just clear that up again. I know we talk about this a lot, but it's so what happens is in these private equity deals, and KKR was a pioneer in doing this. Is they purchase these companies, and so say if they pay $100 for the company, they are going to take out loans for, we'll say 60% of it or 70% of it, or up to even 80. And so the company, based on the um, the performance of the company, they'll then have to service that debt or pay that debt down with the revenue that they're making. So basically, they're not paying 100 for it, they're paying 20 for it, and then the 80 is goes into banknotes or loans that then have to be paid down throughout the existence of the company. And what that does is it allows a lot of leverage, or it allows a lot of agility for whoever's doing these deals, because then they can with a small investment, they can make these much bigger deal than for the investment that's actually happening. So this is sort of the model. Now, if you are generating cash, it's a great model. There's companies that do this because they need cash, they need the money to invest in the brand, and they're able to then generate enough profit to pay down that note, that loan. If you're not generating cash, which we'll get to that in a minute, Accell isn't, it's hands down totally unsustainable.
Right. I
And
mean, yeah,
so,
I think that we talked about this in the last when we had around the analogy with real estate. I mean, if you're doing real
and with
estate
YT,
speculation,
yep,
if you're doing real estate speculation and real estate prices are going up, it's a fantastic business. You can make tons of money,
correct.
with small down payments, and the prices just go up and you make a
Same.
huge return on small down payments. And if though the market turns and you're doing real estate speculation, you have things like the real estate crisis in the US. So then everybody loses everything. And I think this was a leverage buyout is a great model if the company is increasing in value over
Sure.
that time. And if it's going down, then
There's
it's
nothing
very, very painful.
nothing inherently wrong with it. It's just it requires certain types of conditions for it to be
Right.
sustainable and for it to be effective.
Yeah.
And so now we go into things start turning. And I wanted to mention also that post COVID world, the middle is sort of hollowing out in terms of bikes as well. And this is something I spoke with the barbell effect that I spoke with Jeff
Hmm.
Brines about, that I think also contributed to the problems that Excel is facing, is that middle, typically kind of middle of the road in terms of price and features,
Yeah.
has been hollowed out, which, for if you want to listen more about that, we had a whole episode on that with Jeff Brines, the reasoning behind that. But so there's all these gigantic headwinds that just come out of nowhere against Excel. And in addition, there was a regulatory issue with
Yeah.
the safety of the Babboe. What's the
Yeah.
name of it?
Yeah. You asked me how to pronounce it. Babboe,
Okay.
Babboe. Yeah, that's what I would call it. It's
Cargo bike
the
brand.
cargo bikes that are really tricycle cargo bikes often used for child transportation, which was a pretty in my view, quite a strong brand within their portfolio going into Corona. I certainly saw, you see a ton of them around Europe. And there were a number of failures in the bicycle that actually led to,
Recalls.
that had some safety impacts.
Yeah.
And while having safety issues on a bicycle, it happens occasionally. I mean, there's no company that's immune from potential recalls. But here, at least from what you can read about on this one, it became a really big topic because the Dutch authorities stepped in and ordered Babboe to stop selling bicycles because with the argumentation that Babboe and ultimately Accell had failed to investigate all of the cases that they had had, or let's say to chronicle them, figure out what was going on, build a plan for actually how they were going to address these via a recall. And normally, if from what I have read, if they would have followed the correct procedure of doing the internal analysis, recalling the bikes, fixing them, it would have been annoying, but not that big of a deal. But the fact that they didn't respond and didn't do the internal analysis led to the authorities stepping in and saying, okay, we have to step in because you're not taking care of this. And then it became a massive topic. And then they were forced to do the recall under the government's terms, which, from what you can read about, at least in the publicly available information, it was costing them 50 million euros just to do that recall, and not even talking about the impact on the brand value. Because this is a bicycle that's,
For children.
parents are buying
Yep.
for transporting their children, and if
Right.
there's a known safety impact, that's like the worst thing that you'd want to have. So this was a potentially reflecting the amount of, the internal challenges that Excel was facing throughout this period that didn't have the right oversight because they were having probably so many fires that they were trying to fight.
Yeah.
But this one, let's say, added to the headwinds that they were facing,
Wow.
on top of it, which is a real, yeah, I don't know. It's certainly not what you'd want to have happen to
Well, yeah,
your
it's
bike company.
just kind of piling on at that point because you've got a
Yes.
big, healthy cargo bike brand that is completely just gets the legs cut out from underneath it because of this. And then on top of the macroeconomic headwinds that they're facing. So at that point, because of like we spoke about earlier, the structure of the finances of this company, they would have started running out of cash then eventually due to the lack of demand for bikes, the issues that they were facing. And I believe then there were cash injections that were done
Yeah.
because when companies get into trouble, if they don't have enough cash to just pay the people that work there, pay their suppliers. They need to somehow get money in the bank so that they can continue operating.
Yeah.
And at that point, I believe that there would have been some, I don't know the specific moments, but there would have been cash injections happening during 23 and
So
24.
yeah. So from what you can read about it publicly, so KKR they took the company off. They paid a premium on the share price. So I think it's 1.4 billion was the valuation of the company. And if you would have summed up all the stocks, it was, I don't know, 1.1 or something. I think they paid a 30% premium over what the stock valuation was. So they got this company for 1.4 billion. And I just touching on the cash topic. So cash, you have your P&L of the company, how much profit and loss are you making? And then you also have a balance sheet, which talks about how much cash you have. And one of the key components in the cash in your balance sheet during Corona was inventories. So at the beginning, nobody had any inventories. They were sold out of everything, or maybe not Accell, but many other brands didn't have any inventory. But every single bike that you got, you could convert from inventory into cash. As soon as you bought the bike, you got the bike in, you could sell it immediately to a customer full price, and then the P&L looked good. Accell or let's say moving towards 23 and certainly 24, 25, the overstock problem, then your cash it's not in the P&L, it's in inventory. So all the money that you had, you've paid for bicycles that are sitting in your warehouse. And that's where the cash constraint comes. Layer on top of that, the fact that, oh, you have all this inventory, you could theoretically get rid of it by discounting, but everyone else in the market is discounting
Right.
too. So you have two options. Either you can discount even more to try and get it out and convert some of that into cash, but then you'll lose a lot of money. Or you say, let me wait a little bit or discount a little bit less and then stretch this problem out over 2 or 3 years. And I think, you've seen a couple of different brands took different approaches depending on where their position was. But it seems that most of the industry, this was not the inventory problem in the bike industry did not get solved in 6 months. It's still, there's some brands that are still
Sure.
facing it today. So for the most part, they tried to take reasonable discounts and not lose too much money on each bicycle. But that means drawing out that over multiple years, which means your cash is constrained both by more discounting as well as particularly by inventories, by all your money just sitting in your warehouse someplace. And KKR certainly, or they did announce that they injected, I think, another 300 million in 24. They had to inject cash to keep the company afloat,
And the and the
which
debt was written down at that point from 1.4 billion um, to 800
800
million.
or something. Yeah.
Yeah,
So
and
they had, yeah, and I mean, there's a lot of dynamics in there that we're not privy to outside in. How they're doing this, who did KKR borrow money from to do this deal?
right, the banks or
So it's, yeah, you have to go negotiate with the banks, and there's sometimes you're giving up. KKR probably gave up equity to the banks in order to do this. That the banks say, okay, well, you won't pay us back the loans anymore,
we're going to
but
keep ownership of
yeah,
the
we own now part of this company. So if there's upside, we're going to make some money.
right.
Those are complex negotiations, but they certainly injected money and they wrote off debt, which with some of those dynamics happening in the background. And I think it's important, though, here to note that from my understanding, most bicycle brands needed cash to get through this period because almost everyone had overstocks. And it's typically the owners that bring in cash injections. So if you're I mean, if you're a company that's privately held, then you go to your whoever owns you and say the management says I need X to get through this next year, and then the owners need to make a decision on do we want to. I mean, you almost have to do it because if you don't do it, then the company will, if you essentially go bankrupt if you run out of cash, even if you're profitable.
Yeah.
Um, and my understanding is that most companies did put cash or received cash injections to get through this period. So the fact that they got a cash injection per se is not
No,
negative.
it wasn't unique in any
Uh,
way.
and it certainly seems that KKR and the Accell leadership started a very, very thorough restructuring pretty quickly. That they went through a couple of different CEOs. They've announced closing one of their plants in the Netherlands, shifting production to Hungary. There's they've in these most recent articles that have come out with some access to insider documentation. It mentions that they're really pushing towards consolidating a lot of their back office and a lot of their because currently we mentioned at the beginning there's many different brands and pre-corona each brand was managed independently. It's not like one office that has six brands coming out of it. It's six different offices with six different purchasing companies doing six different brands. So there's limited amounts of ability to consolidate functions. There seems to be a big push now at Accell, probably driven by KKR, to build a more efficient company and a more lean company that can handle less revenue and less profitability. And it seems that they have done quite a lot already. And that if you read these external articles, that they're nearing the end when they think they can be sustainable again, but that they're looking for yet another cash injection
Well, yeah, and
to get through these next, I guess, to get through 2026.
right, and what happened was KKR actually exited. They walked away in February. This was kind of what I had written about. Walked away from almost entirely their $1.1 billion of equity investment, which so now, like we talked about, probably the banks or whoever took on the debt owns the company now. And if you guys want to go in and see, the company is again, like Sam was talking about, like you were just talking about, Sam, about finding ways to trim down the cost because the company is still not profitable. And if you're not profitable and you have all this debt, like it's impossible for you to continue.
Yeah,
There's
and if you,
no,
I mean, if you believe the information that these articles are citing from this internal document that says, I mean, if you say a company that Excel has lost or is projected to drop below, I think it was 800 million, let's say around 800 million revenue now. And at their peak, they were up at 1.3 or something. So you're talking about, I mean, any company that loses 40% of its revenue is going to have a really hard time paying their, let's say, their standard, the fixed
Right.
costs that
Operating.
exist in a company. If you
Yep.
lose, it's like if you're losing half your, if you're working and you get a 50% pay cut in your job, you still have to pay your rent and you still have to pay your groceries. It's very, very difficult for a company to survive that kind of cut to its top line without having to then go do major cutting on the cost side. And they have been doing that. It's a lot harder to remove cost than it is to add it. It takes time.
Sure.
And that's where apparently the Accell leadership is asking another for patience and looking for another investor to come in who could give it that amount of cash that would get it across this final line when, if they're back to around 800 million revenue, if they can be profitable again, then the business is yet again is viable again and can start slowly maybe going back to the path they had pre-corona of slow growth and being profitable. So it seems from outside in they have done a lot, but that these things become very, very challenging, particularly if you're operating. I mean, it's also a good analogy to bring here is if you're trying to do a massive cost cutting, which they had to do in an environment where you're highly leveraged, so they have and very cash constrained. And again, more analogy is it's like when you're living month to month as a person, if you have to, if you have a bit of cash that you can allow yourself to go up and down, you don't have to you don't have to look at every single cent coming in or every single dollar or euro coming into your account every month and have to pay your rent, waiting to like the exact day to be able to do it. When you are cash constrained, you are not flexible and you are firefighting and your organization is distracted. You can't work on long-term topics because you're working on how do I pay my bill this month? And that slows you down even further on doing the cost cutting that's necessary. And, that's a
It's
companies
difficult. It's
become,
difficult.
yeah,
And you
paralyzed
and
in those
you
situations.
and you live this.
Yeah, that's what we have. I mean, YT, we were paralyzed for a while and we knew what we needed to do, but we simply didn't have the resources to move that fast given the month to month surviving this month becomes more important than solving the things that you have to do in the next 6 to 12 months. And that is okay if you have it for a month or two. And then if you can get to a point where you have a little bit of breathing room. And it sounds that Accell has been kind of operating in this mode now for a couple of years. And while they've done, it seems quite a lot, it still hasn't come as quickly as they had hoped, which I think is very typical for companies going through these kinds of things.
It's so hard, man. It's so
And as you
hard.
mentioned, KKR, I mean, for them to make money back, this isn't, they walked away for their investment, so they have to write off all of that. For them to make money, it's not just that the company has to be profitable again, it has to be, let's say, near what it was before. Because if you think about a house, like if you bought a house at one valuation and now it's gone down by 20 or 30%, and you put 20, 30% down, even though the house is still worth something, it all belongs to the bank and you need it to actually increase in value for you to really
It's
make
a long
money on
road.
it.
No, it's we're talking about it in really kind of how would we say sanitized terms, but this is a mess because this is so hard for them, and there's really no way to kind of dance around the topic. And you have specific insight. And when I heard your interview with Jeff Brines, I could just tell that like it was you were literally hand to mouth, just trying to keep the lights on at YT.
Yeah.
Where and the only lever it feels like, or one of the biggest lever you had was discounting, which is like a death sentence at the end of the day because it's so hard if you're discounting because you're eroding brand equity. So it's like you really don't have any easy. It's like a rock and a hard place at this point.
Yeah, I mean, I certainly don't feel, or I do feel for the management teams and all the employees who are trying to manage through this. It's not easy for or it hasn't been easy for anyone in the bike industry, and certainly not for brands who are operating with a product portfolio similar to Accell. And again, it was hard enough just with that.
In good conditions. Yeah.
Right. And then
The debt.
the debt structure, which is probably unique to them that the others didn't have. That makes it even more hard. And I mean, I think they almost had, a perfect storm of what could have a perfect storm. Certainly from KKR's perspective, they bought in at the ultimate peak, sunshine and roses, and then showed up end of 22, beginning of 23, and we're like, oh my God, what are we going to do here? How are we going to solve all these problems at once? And I would even, I think it's one part that we didn't talk about before that I think is also really interesting for the bike industry per se, is understanding why, how quick is an organization to responding to changes in customer demand and to supply shocks. And so I mean, I was working at a direct-to-consumer bicycle company, and Propain's direct-to-consumer. So I'm when you are a direct-to-consumer bicycle company, or if you're an OEM that sells direct-to-consumer, so like a Trek or a Specialized that have their own websites, you see changes in customer demand daily. You can look in and see what models are selling particularly well, what trends are picking up, what components are working well. These are all things that there's basically instantaneous feedback on what your pricing's doing, what your looking at your SKUs, are size is changing, what colors are working, all those things you see in real time. If you are like Accell selling through bicycle dealers, you see how many bikes you sell to the bike shop at the beginning of the season.
But you don't
But
know
you
what to
don't
sell
know
through.
typically their sell
Yep.
through. You don't know what they're selling on the shop floor. You don't even know maybe how many units they have left in their warehouse or in their on their bike floor. You only see it when they come back to you saying, "I need more stuff." That is that delay in understanding it works okay if customers aren't changing their opinions very quickly. As I think, let's say that the speed of pre-corona, that things weren't changing that rapidly. With corona, there was a massive changes, right, in demand and then supply. And I think also with e-bikes, there's been a lot of now there's while components that are not e-bike related, or let's say not motor battery related, there's stability. But the changes with the new motor systems coming out, which we all hear about now, particularly in the last month, with Abinox coming, and which motor system you're choosing, making sure you get the right setup becomes really important. And it's a real challenge, I think, for bike companies to operate in the traditional model. I mean, there's a lot of benefits. Your bike shops are great for being close to customers and having service points. And so I'm not bad
Or they're
mouthing that
required.
as a channel, but
They're required. I know you work for Propane, but bike shops are so important for the business, regardless.
absolutely.
Pure,
And I think that's an area that you see a lot of direct to consumer bike companies looking to invest in
they have
dealer
to.
networks,
They
yeah,
have
for
to.
doing service and places that customers can, if something goes wrong with your bike, and e-bikes break down more often than pedal bikes, or they have more, software issues or battery issues or motor issues. This is a trend that you see, but the pure dealer model is inherently slow. And I think that was
Sure. From a
yet
data.
another challenge that Excel had to face, that they probably were very slow to react. But when, I mean, at YT, I remember it's middle of 2022, we started, for the first time, we started launching new bikes, bringing out new bikes and not selling through everything immediately. And that was a big change because basically from mid 20 until early 22, basically every model we could bring online, we were selling through immediately. And then you started seeing, oh, actually, we still have some sizes left. Started with that, and like, oh, okay, now we have some models that aren't totally sized. Still okay, but they're not selling through like on the first day when we put them online. And there you could see, well, maybe we should how many bikes do we have on order? Maybe we should reevaluate this
Right. And
and
kick.
start thinning it out. We started thinning out middle of 22, and by the end of 22, we had canceled everything that we had, and then went back and ordered selectively much smaller numbers. And I wouldn't be surprised if Excel or bikes companies like that, they didn't notice it. They maybe needed 3, 6, 9 months more to
Sure.
see these trends. And if they canceled that late, I think when you were the first person to cancel is easiest, because then all of a sudden the component suppliers and the assemblers start seeing cancellations coming, and then they see their whole business drying up, and then they're going to fight back and say, no, 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 you can't cancel that anymore. That's already committed. You can delay it maybe. And that's why a lot of these inventory problems, it's not that all those bikes were delivered in 2022 that they're still sitting on. It's that those were bikes that were ordered in 2021 or 22, and then the OEMs make deals with the assemblers and component suppliers. Okay, well, let's delay it. Just push it out a year or 2 or 3, and then I'll still buy it, but I can't sell it right now. And so, I mean, at YT, I think the last delivery we had from, let's say, the boom orders were, I think it was by early 24, we had the last bikes that we couldn't cancel. And I imagine for somebody like Accell, they were probably getting orders well into 25.
Oh, wow.
And those were bikes that were spec'd in 21 and ordered in 21, or maybe in early 22, and that got delayed. But those were, that's yet another challenge, and certainly a big opportunity for the bike industry. If you can speed up these cycles of recognizing customer demand, adjusting the supply chain, and then if you look at the supply chain, if you have component suppliers, frame manufacturers who are able to scale or flex their manufacturing up and down based on demand, or if you look at tariffs in the U.S. would be another big some things that swings up and down like from today to tomorrow. The more flexible your manufacturing base is and the better demand and supply signals you have, the better the industry is going to get through these things. And that's certainly an area where I still believe the entire bicycle supply chain, from OEMs to component manufacturers and frame suppliers and assemblers, everyone needs to get better in building more flexible manufacturing, but particularly in sharing data, in looking at data, consumer data, and identifying trends early, adjusting accordingly, and the more flexible, having fewer SKUs that you can swap out things more easily, reduce complexity. These are all things that are beneficial to the industry to be more healthy and resilient for the next crisis, which will come. And we don't know what that will be, but you can be sure there will be crises that are coming.
So coming back to Accell, so they're in an incredibly critical moment right now where we're going to see over the next few 6 to 9 months, because I guess if anything could happen, it would be another potential running out of cash again. So we'll see. I guess we'll kind of keep our eyes on this, and then we'll probably need another injection at some point. But I guess we'll be watching this. I appreciate you coming on, Sam, and talking about this. This was interesting, super interesting insight from a director level, CEO level view. So this was really cool. And yeah, man, it's always good having you on. You're kind of becoming the de facto CEO that's coming onto the show. So I really appreciate it, man. And it's fun having you. It's fun seeing your insights. And I'm glad you're back in the industry. I think we did talk about this last time, but it's cool to have you back in the industry now and over at Propain. So thank you, Sam. And we will be seeing each other at Eurobike, maybe?
Yeah, I'm hoping to go for a day on the Friday. So I'll swing by and say hi to people, have a beer.
Okay. We'll see each other then.
Cool. Thanks, Wyatt.
All right, man.